Introduction to financial markets.
The global financial markets move $7.5 trillion every single day. That's enough money to buy every NFL team 150 times over. And today we're diving into how this massive system actually works.
That's such a mind-blowing comparison. And what's fascinating is how these enormous numbers affect everyone, from major institutions down to regular people checking their retirement accounts.
Well, it's interesting because financial markets are essentially just sophisticated matchmaking services. You've got businesses needing capital meeting investors, wanting returns, all happening through this incredible auction system.
Could you break down how that auction system actually functions? I think many people hear about markets but don't understand the mechanics.
So imagine a giant marketplace where instead of haggling over produce, traders are negotiating prices for stocks and bonds. The final price gets set when supply meets demand, what we call the course in market terminology. And this happens millions of times every day across different exchanges.
Hmm. And these exchanges have really evolved over time, haven't they? The NYSE isn't just people shouting on a trading floor anymore.
That's exactly right. We've got these massive institutions now. The New York Stock Exchange leads as the world's largest, followed by NASDAQ, Euronext in Europe, and major exchanges in Frankfurt, London, and Tokyo. But here's what's fascinating. These traditional exchanges are just one part of the story.
Oh, you're talking about the rise of decentralized markets, aren't you? That's been such a huge shift in recent years.
Well, think of it this way. Traditional exchanges are like shopping malls with strict security and set hours. Decentralized exchanges are more like a vast network of independent traders connecting directly. No central authority, no single point of failure, and usually much more privacy.
That makes so much sense. And it really explains why cryptocurrencies have embraced this model so strongly.
Exactly. And then we've got this fascinating middle ground called the OTC market. It's like this massive invisible network where traders deal directly through phones and electronic systems. The daily trading volume is staggering, especially in forex.
Speaking of forex, isn't it amazing how that market never really sleeps? Following the sun from Asia to Europe to North America?
You know what's even more incredible? Forex moves about 10 to 15 times more money daily than all the world's stock markets combined. We're talking $7.5 trillion every single day. And thanks to online trading, almost anyone can participate now.
That accessibility is really changing the game, isn't it? Though I imagine it comes with both opportunities and risks.
Well, that's where understanding market structures becomes crucial. Centralized markets offer standardization and heavy regulation. Everything's uniform and transparent. But they often require significant capital to participate.
And I'm guessing decentralized markets offer more flexibility?
Exactly. Different brokers, different conditions, different prices. The competition usually means lower costs for traders, plus the ability to use leverage. But here's what's really interesting. These different structures serve different purposes in our global financial system.
That reminds me, how do you see these markets evolving with new technologies like blockchain?
Well, we're already seeing this fascinating hybrid evolution. Traditional exchanges are adopting blockchain technology while maintaining their centralized structure. Meanwhile, entirely new markets are emerging through DeFi platforms.
And all of this affects everyone, whether they're actively trading or not, right?
That's precisely what makes this so important. Every time someone takes out a mortgage, uses a credit card, or saves for retirement, they're interacting with these markets. They influence everything from interest rates to the price of imported goods.
So what should people keep in mind when thinking about these markets?
Well, the key is understanding that whether you're dealing with traditional exchanges or newer platforms, knowledge is crucial. These markets are becoming more accessible, but that also means people need to be more educated about how they work and the risks involved.
Those are some really valuable insights to wrap up with. It really shows how these complex systems touch all our lives.
And that's what makes financial markets so fascinating. They're this invisible force shaping our economic reality, whether we're actively participating or not. Understanding them is the first step to navigating them successfully.
Instruments traded in the financial markets.
$7.5 trillion. That's the mind-boggling amount traded daily in just one financial market. And today we're pulling back the curtain on how these massive global markets shape everything from your morning coffee to your retirement savings.
That number is so large, it's almost impossible to comprehend. To put it in perspective, that's more than the entire GDP of most countries changing hands every single day in the forex market alone.
Let me tell you something fascinating about how these markets touch our daily lives. Take Starbucks, for example. They have to plan their coffee purchases a full year in advance through commodity exchanges just to ensure they can serve that morning latte.
You know what's really interesting about that? It shows how these seemingly abstract financial markets have real world implications for businesses and consumers alike.
And speaking of real world implications, let's dive into stocks first. When you own even a single share of a company, you're not just holding some digital entry, you're actually becoming a partial owner with real rights and privileges.
That reminds me, could you break down exactly what those ownership rights entail? I think many people don't realize what they're actually getting when they buy stocks.
Well, here's what's fascinating about stock ownership. You get voting rights at shareholder meetings, potential profit sharing through dividends, and even a claim on assets if the company liquidates. It's like having a tiny piece of the corporate pie.
That's such a shift from how stocks used to work. Those beautiful paper certificates that people kept in safety deposit boxes seem almost quaint now.
Speaking of evolution in the markets, let me tell you about something even more transformative: the rise of stock indices. Take the German DAX, which tracks 40 of Germany's largest companies like BMW, Adidas, and Siemens. When you invest in that, you're essentially buying a slice of the entire German economy.
Hmm, that really explains why index investing has become so popular. You're spreading risk across multiple companies instead of putting all your eggs in one basket.
And here's where it gets really interesting. These markets are all interconnected in ways that might surprise you. Currency values are actually tied to specific commodities. The Canadian dollar, for instance, tends to move with oil prices.
Oh, and don't forget about how the Australian dollar often moves in sync with gold and iron ore prices. It's like this intricate dance of global commerce.
You know what's even more surprising? New Zealand's entire currency can be influenced by global dairy prices. When milk prices change significantly, it can affect their whole economy.
That's exactly why understanding these markets is so crucial. They affect everything from our grocery bills to our investment returns.
Well, looking toward the future, these markets will only become more interconnected. The rise of digital trading, cryptocurrency, and global commerce means we're all affected by these financial instruments, whether we realize it or not.
And that's why staying informed about these markets isn't just for traders. It's for anyone who wants to understand how our modern economy really works.
Let me leave our listeners with this final thought. Whether you're investing in stable blue chip stocks or following the wild swings of cryptocurrency, understanding these markets is key to making informed financial decisions in today's interconnected world.
Trading terminology.
Did you know the forex market trades over $6.6 trillion every single day? That's more than 25 times the size of all global stock markets combined.
Those numbers are absolutely mind blowing. How does anyone even begin to understand a market that massive?
Well, let me break it down in a way that makes sense. Think of forex trading like exchanging money at an airport. But instead of doing it for vacation, traders do it to profit from tiny price changes between currencies.
That makes sense, but surely you need huge amounts of money to get started, right?
That's what's fascinating. You actually don't. While a standard trading lot is $100,000, brokers let you trade with much smaller amounts using something called leverage. Let me give you a real world example.
Hold on. $100,000? That's what they call a standard lot?
Exactly, but here's where it gets interesting. Brokers break this down into smaller sizes: mini lots of $10,000, micro lots of $1,000, and even nano lots of just $100. It's like buying a slice of pizza instead of the whole pie.
Hmm, that makes it sound more accessible. But you mentioned leverage. What exactly is that?
Picture leverage like a financial magnifying glass. If you have $1,000 and your broker offers 1 to 500 leverage, you could potentially control $500,000 worth of trades. It's similar to putting a small down payment on a house, but controlling the whole property.
That sounds incredibly powerful and dangerous.
You're absolutely right. It's like driving a Formula One car when you're used to a regular sedan. That's why successful traders use something called margin to manage their risk. Think of margin as your safety deposit.
So, how do traders actually know when to buy or sell these currency pairs?
Well, that's where we get into different trading styles. You've got scalpers who are like the day traders of Wall Street, but on steroids. They might make hundreds of trades per day, sometimes holding positions for just a few seconds.
That sounds incredibly stressful. Are there other approaches?
Oh, definitely. Day traders are a bit more relaxed. They might hold positions for a few hours and make maybe 5 to 10 trades per day. Then you've got swing traders who hold for days or weeks, and position traders who might stay in trades for months.
Tell me more about these different trading styles. Which one do most people start with?
Most beginners actually start with swing trading, and there's a good reason for that. You don't need to be glued to your screen all day, and you can analyze the market during your morning coffee. But here's what most people don't realize.
What's that?
Swing trading requires incredible patience. You might wait days or even weeks for the perfect setup. And then when you're in a trade, you need to handle the emotional roller coaster of price swings while you sleep.
That psychological aspect seems really challenging. How do traders handle that?
They use something called stop loss and take profit orders. Think of them like you're trading autopilot. A stop loss automatically closes your trade if the market moves against you by a certain amount, while take profit locks in your gains at a predetermined level.
So it's like setting boundaries for your trades before emotions can take over?
Exactly. And this ties into one of the most important concepts in trading, the reward to risk ratio. Let's say you're risking $100 to potentially make $300. That's a 3 to 1 ratio, which means you can be wrong 60% of the time and still make money.
That's fascinating. It's not about being right all the time. It's about making your winners count more than your losers.
Precisely. And here's something most people don't realize about the forex market. It's actually divided into three major trading sessions: Asian, European, and North American. Each session has its own personality, like different acts in a play.
How do these sessions differ?
The Asian session tends to be more range bound, perfect for certain trading strategies. The European session often sees the most volatility, especially when it overlaps with the North American session. That's when about 70% of all daily trading volume occurs.
Speaking of trading volume, how do brokers handle all these transactions?
That's where the spread comes in. It's the difference between the buying and selling price. Think of it like a car dealership. There's always a difference between what they'll buy a car for and what they'll sell it for. That's how brokers make their money.
And I imagine choosing the right broker is crucial.
It's absolutely critical. You want to look at their regulation, execution speed, platform stability, and customer support. But here's something many new traders overlook. The educational resources a broker provides can be just as important as their trading conditions.
What should people look for in those educational resources?
The best brokers offer comprehensive trading courses, market analysis, and even demo accounts where you can practice with virtual money. But here's the key: make sure they teach risk management before anything else. That's what separates successful traders from the rest.
This whole conversation has really opened my eyes to how complex yet accessible Forex trading can be.
That's right. And here's one final thought: successful Forex trading isn't about making quick money. It's about developing a systematic approach, understanding risk management, and having the discipline to stick to your strategy even when emotions try to take over.
So it's more like running a business than gambling?
Exactly. The most successful traders treat it like a business. They have a trading plan, risk management rules, and they track their performance meticulously. It's not about getting rich quick. It's about building sustainable success over time.
CFD, contracts for difference.
Financial markets can seem intimidating, but here's something wild. Imagine betting on whether Amazon stock will go up or down without ever actually owning a single share. That's exactly what millions of traders do every day with something called contracts for difference.
That's such an interesting way to think about it. How exactly did this kind of trading become so popular?
Well, it all started back in 1990 when a London broker had this brilliant idea: create a way for people to trade stocks without the hassle of actually owning them. Think of it like shadow boxing with the market. You get all the moves without taking the actual hits.
Hmm. So it's basically like making a bet on price movements? There must be more to it than that.
Oh, there definitely is. You see, when you trade a CFD, you're entering into an agreement where you'll either receive or pay the difference between an asset's current price and its future price. And here's what's fascinating: you can do this with almost anything: stocks, gold, oil, even cryptocurrencies.
That sounds almost too good to be true. What's the catch?
Well, you know how they say leverage is a double edged sword? With CFDs, you might only need to put down 5% of the total trade value, but, and this is a big but, your profits and losses are based on the full amount.
Oh, wow. So you could potentially lose more than your initial investment?
Exactly right. Let me give you a concrete example. Back in 2018, if you wanted to trade the German DAX index through traditional futures, you needed about 21,000 euros just to hold an overnight position. That's some serious capital.
So that's where CFDs come in to make it more accessible?
Precisely. With CFDs, you could trade the same market with a fraction of that amount. And here's something really cool: you can split your positions. So instead of one big 21,000 euro trade, you could do multiple smaller trades with different profit targets.
That flexibility must be really attractive to smaller traders. But what about the costs involved?
That's actually changed quite a bit over the years. While CFDs used to have higher commissions than futures, many brokers now offer zero commission trading. But, and this is important, you need to watch out for the spreads and overnight holding fees called swaps.
Tell me more about these swaps. They sound like they could really impact your bottom line.
Think of swaps like a nightly hotel charge for keeping your position open. The rate depends on the interest rates of the currencies involved. Sometimes you might even earn money from positive swaps, but more often than not, they're a cost you need to factor in.
That's fascinating. How do successful traders manage all these different factors?
It's really about understanding which markets work best for CFD trading. Take the DAX index. It has this sweet spot where the spread compared to daily price movement makes it ideal for CFD trading. Same goes for NASDAQ and gold. But for other markets, not so much.
Sounds like there's quite a bit of strategy involved in choosing what to trade.
Absolutely right. And here's something that might surprise you. Despite all these advantages, CFDs are actually banned in the United States due to lack of regulation. It's kind of ironic when you think about it. A financial innovation that's become hugely popular everywhere, except in the world's largest financial market.
That really puts things in perspective. What would you say are the most important things for someone to know before getting into CFD trading?
First and foremost, understand that leverage is like fire, useful but dangerous if not respected. Second, always use stop losses to protect yourself. And third, start small and practice with a demo account first. You know what they say: the market is the most expensive teacher if you don't do your homework.
Those sound like solid principles to follow. Any thoughts on where CFD trading is headed in the future?
Well, we're seeing some interesting trends. More markets are becoming accessible, costs are continuing to decrease, and technology is making it easier to trade. But the fundamental principle remains the same. CFDs are powerful tools that require knowledge and discipline to use effectively.
Looking back at everything we've discussed, it's clear that CFDs have really transformed how many people approach trading.
They absolutely have. And while they're not for everyone, they've democratized access to markets that were once the exclusive domain of large institutional traders. The key is understanding both the opportunities and the risks they present.
Thank you for breaking this down so clearly. I think our listeners now have a much better grasp of what CFDs are all about.
Indeed. Remember, folks, in the world of trading, knowledge isn't just power, it's profit potential and protection rolled into one. Choose your trades wisely and never stop learning.